Well, here I am going to discuss about the topic risk management strategies for barrier options. So, first of all, let us discuss what you mean by barrier option. So, barrier option is also like a derivative contract. A derivative contract is whose value is derived from an underlying asset. So, here also the barrier option is a type of derivative contracts. Its payoff is depends upon its underlying asset price, which means it can vary the underlying asset price as per the asset price of the underlying asset. This payoff reaches at a specific price level. It is called as the barrier during the lifespan of the barrier option. So it can be divided into two, knock-in and knockout. Knock-in means this barrier options become active when it reaches the barrier, and knockout is just opposite to knock-in, which means the option become worthless when the price reaches the barrier. So here are what are the key risks that are associated with this barrier option. So first one is barrier risk. So barrier risk means there can be a change in the price of underlying asset due to various reasons. There are various factors in the environment which affect the price of underlying asset. So underlying asset price will depend on, or it will affect the barrier option directly. So this is the first risk, which is barrier risk, the risk associated with the underlying asset price, and also it will reach the barrier either by activation or deactivation of the option as discussed earlier, knock-in and knockout. So volatility risk, it means barrier options are highly sensitive to the price of their underlying asset. So various conditions increases the chance of volatility risk. And the third key risk is time decay, or it can be expressed as theta. Like it is the barrier option also experience time decay, because when the expiry date of the barrier option approaches, due to time decay, the price of the underlying asset or the value of the barrier option can be knocked out. And this is liquidity risk, which means in barrier option the liquidity is comparatively low than standard options. So it also poses a huge risk of buying barrier options. Next is counterparty risk, which means if the barrier options is trading through over the counter exchange, there is a risk of counterparty, because counterparty have a risk of they couldn't fulfill the terms of the contract. So it is also in the barrier option. Next is using other option, because barrier option, instead of barrier option we can use standard options or other derivatives, so it is also increases the risk. So these are the strategies how to assess the risk that discussed above. The first one is careful selection of barrier level. So the barrier level, a price level, should be set by careful evaluation of several market conditions and the environmental conditions. Next one is about volatility analysis. Even though we have discussed about the various factors which increases the volatility of the barrier option, so due to the volatility, it should be analyzed properly the underlying asset and what are the things that will affect the underlying assets and its price. Next is stress testing. It means due to the various conditions in the market, it can be increases various risk and unconditional factor. So it should be tested through stress testing. It is a simulation model, so it can evaluate the impact of various conditions to this barrier option. Next one is about diversification, which means if we are diversifying among various classes of asset, even if one asset give us loss, other asset can increase the profit. So risk mitigation can be done through diversification. And the last point is understanding option Greeks. That means how the option price is affected by the underlying asset. that means volatility vega and price delta and time theta. It should be, these three should be evaluated before purchasing or selling a barrier option. And this is a simple example for the scenario of this barrier option, how it works in the market. So this is an up and in call option. So there is a down and in call option. So here I am going to discuss about just up and in call option. Its opposite is down and out call option. So scenario 1 is this. That means an investor believes in a stock and currently trading at rupees 100. It rise significantly. There is a chance to rise this 100 rupees, but they want to limit it with their upfront cost. That means they purchase it with a strike price of $110 and at a barrier level of 120. So expiry date is 3 months. So let us look how it works. So the option is initially inactivate, it is just 100 rupees, and within 3 months stock price has reaches to 120 as the barrier. We have set the barrier of 120. So if the stock price reaches 120, the barrier, the option knocks in. That means the option become activate and it becomes a standard call option. But instead of that, if the stock price reaches 130 by expiry, 120 is our barrier and it is $10 above. So here also the investors can exercise the option by buying the stock for 110 because he set at the strike price of 110. So he can purchase it for $110 and he can attain a profit of 20 rupees. And if the stock price doesn't, this is the third condition, if the stock price never reaches 120, that is the barrier level. If it does not reaches 120, the option becomes worthless. So the purpose is that it allows the investors to participate in the price level and the investor can enjoy various conditions in the market at the same time. It have certain risk too. So that's about our topic about barrier options, what are the risks associated and how these risks can be evaluated or the various strategies and a simple example. So that's about it. Thank you.